Welcome back. We'll now proceed to our first panel. The goal of this panel is to discuss the adequacy of our current financial regulatory framework. A decade ago, Congress passed and President Obama signed the Dodd-Frank Act, which was designed to substantially reform the U.S. financial regulatory system in the wake of the 2008 financial crisis. Last year, we witnessed the first economic shock to the financial system since the enactment of Dodd-Frank, which makes this the appropriate time to assess whether the act lived up to its promises. We're fortunate today to have three former congressional staffers who all played a major role in Congress's consideration of the Dodd-Frank Act to give their insights on the legacy of the bill. Our panel consists of Mike Pivovar, who is the executive director of the Milken Institute Center for Financial Markets. He is a former SEC commissioner and acting chair. He was the Republican chief economist at the Senate Banking Committee during Dodd-Frank. Kevin Edgar is counsel at Baker Hostetler. He is the former chief counsel at the House Financial Services Committee. Jonah Crane is a partner at the Claros Group. He is the former counsel to Senator Charles Schumer and served as the Deputy Assistant Secretary for Financial Stability at the U.S. Treasury Department. So I'm going to start in by asking a question for all three of you, which is, Dodd-Frank sought to enhance the financial stability of the United States with a series of very broad reforms, including creating several new regulatory bodies, such as the CFPB, the FSOC, sought to reform bank regulation and derivatives markets, establishing a new resolution authority, and new lending rules for mortgages, amongst other reforms. In light of last year's economic downturn, which provisions of Dodd-Frank actually did live up to its promise of enhancing financial stability enhancing the financial stability of the United States, as opposed to just talking about the act as a whole? I'm interested in your views about. Let's talk first about specific provisions. Mike, why don't I start with you? Where do you actually think the act held up well?
Yeah, thanks, Andrew. I think one of the provisions in Dodd-Frank, one of the titles is Title VII, the over-the-counter derivatives provisions, right? And although I have some serious concerns about some of the very specifics of that title, the one thing that it did do was it provided regulatory transparency in the over-the-counter swaps markets. If you think back to the global financial crisis, one of the reasons why the government had to step in so many different ways is simply because the regulators had no idea what the true exposures were in this market. I was working at the White House at the time, and part of my job was to try to figure out who was the next one to go after we had Bear Stearns. And we were looking at all the regulatory reports, SEC required filings, the bank regulatory requiring filings. And prior to Dodd-Frank, no one was permitted, the regulatory agencies were actually prohibited by law from having information about the exposures in the over-the-counter market. And so we had surprises like AIG, where we had a lot of the big banks were exposed on one side of credit default swaps. So I think if I've been very, very critical of many things of Dodd-Frank, we'll probably get into it. But I think one of the things that did work to the extent that we could see in this crisis was that the over-the-counter reporting, the reporting of over-the-counter derivatives positions gave confidence and comfort not only to the regulators, but to market participants that there weren't hidden counterparty risks this time around.
Kevin, do you agree with that assessment? Or do you have other areas of Dodd-Frank that you think actually held up pretty well?
Yeah, thanks for having me, Andrew. So I would agree with Mike. I also think that there were components of Title I in terms of the enhanced prudential authorities that were given out worked, and certainly the regulators' ability to exercise organic authority that they have and maybe were reluctant to or didn't feel that they could use it. Those powers certainly came to light last year, and the flexibility that regulators were attempting to provide regulated entities certainly helped. But because this was not a lending crisis last year, right? It was a broad economic crisis. Dodd-Frank is not 100% applicable to what to what we experienced last March and April.
Jonah, what do you think? In terms of the statute, on the other side, you're on the other side of the aisle that you thought at the time, and in particular, which areas what provisions of the bill do you think actually worked pretty well last year?
Yeah, thanks, Andrew, and thanks to the Federalist Society for inviting me to join this timely conversation with some former colleagues who I respect a tremendous deal. As Kevin notes, I think this is an interesting crisis through which to think about Dodd-Frank because, for various reasons, might be thought of as perhaps not the best stress test on which to hinge definitive conclusions about the stability of the financial system. The pandemic was so overwhelming. Now, I happen to think that's a very good thing. And 15%, you would have expected a lot more stress. The banking system came into this crisis with more than double the levels of capital that it entered the financial crisis in 2008 with, and that was, I think, proved important. And you saw regulators at the beginning who continue lending to consumers and businesses, and I think that was all part of an important response to the pandemic that helped to put some real support under the economy at a critical time. So I think on the capital and prudential measures, pretty high marks. I think I would echo Mike in saying that Title VII seemed to have worked well. I mean, this was a difficult crisis with at the outset some real financial market volatility, and we didn't see any real blowups in some of the corners of the markets where we did before. I think in addition to the transparency Mike highlighted, I think the sort of robust infrastructure and central clearing that was put in place following the prior crisis seemed to have worked well in those markets. And there are probably lessons, maybe we can get into this, there are probably lessons for some other markets that we could think about. So I think on the whole, those are the two areas I'd look at in response to this crisis. And I think on in those areas, Dodd-Frank performed well, although perhaps a grade of incomplete, as it were, given the unique nature of this crisis.
Now, Kevin, I think I want to follow up on something you said, which is, certainly I think across the aisle, there's a recognition 10 years ago that bank capital needed to move up. And we've seen that over the ensuing 10 years. And that seems like there's been a strong agreement amongst regulators, Congress, private sector, the capital had to increase. But I'd love to hear a little bit more about your comment about whether or not it was actually Dodd-Frank that was responsible for the increase in capital, as opposed to regulators who already had that authority on their own, moving up capital, and also market forces moving up capital. How much would you attribute it to Dodd-Frank that success?
So it's a good question. Certainly, the Fed always had the ability to set capital, and they did so with their international counterparts. And we've all, at least those of us that were still in Congress following the enactment of Dodd-Frank, kept being told, well, remember, there's two sets of stress tests. There's the Dodd-Frank mandated stress test, then there's the Federal Reserve mandated stress test. So we knew that the Fed had authorities that they could exercise. Frankly, all the regulators had authorities that they could exercise, probably with the exception of the Title VII derivatives markets, which were new authorities. So we always knew that the banking regulators had a great amount of organic authority to tell their regulated entities, here is what you must do, here are our expectations. Whether they exercised it or not is another question. And then where there were, I don't want to say, where there were maybe potentially holes, sure, those were filled by Dodd-Frank, particularly Title VII, possibly Title IV with the oversight to the SEC of private advisors to private funds. A few other areas, clearly Title II was an area that some perceived as a hole in the need to have a single resolution system. But there were criticisms, at least sitting where I was sitting, that you had authority, you didn't use it. Why didn't you use it? Why do you need more authority? Are we just going to give regulators more and more authority that they clearly aren't going to use? So that was at least sitting in the House Republican minority at the time. That was a challenge that we were always thinking about.
So let's move into some of the more critiques of the statute. Then, Mike, as you look back now, what do you think were the real flaws of Dodd-Frank and the problems aspects? And your critiques at the time, do you think they've held up well?
Yeah, so I mean, some things are too early to tell, right? So Kevin mentioned, Title II orderly liquidation authority. Some of us still have concerns that that's not going to work. We just don't know at this point. We haven't had a large failure of a bank, and one of the things that's remarkable in this crisis is, as Jonah pointed out, the bank capital levels were much higher, and it's you can look at it. In this crisis, banks were part of the solution, not part of the problem, right? They were the ones that were implementing the PPP program and some of the other things. And as Kevin pointed out, a large part of that was not due to Dodd-Frank. It was authorities that the regulators already had. And one of my frustrations was the fact that, during Dodd-Frank, there was this huge emphasis put on so-called macro-prudential regulation. I always viewed that in large part as the regulatory agencies trying to divert attention from the fact that they didn't do their micro-prudential regulation correctly. And I think there were gaps in terms of using their existing authority. In terms of Dodd-Frank provisions that are shown to be particularly problematic, I think in this last crisis, as Jonah pointed out, we had the fragility of some markets where the Federal Reserve had to come in. And I would point to the Volcker Rule, and this was something that many of us had concerns with, right? So the purpose of the Volcker Rule was to make bank balance sheets safer. And in fact, they did. What they did was they took off of the bank balance sheet some risky activities, proprietary trading and investing in covered funds. But by doing so, by making the banks safer, remember that the banks prior to Dodd-Frank were the traditional providers of liquidity. They were the big dealers, the big traders in these markets, and their balance sheets provided sort of shock absorbers for these particular markets. And so when this crisis comes along, the banks have now, because of the Volcker Rule, have had to pull back in so many different markets. Not only in this crisis did the Fed and Treasury reopen the credit facilities they did in the last crisis, they actually had to extend them into markets that they've never had to intervene in before. The corporate bond market, the municipal bond market, for example. And so I think what this crisis shows is that that the Volcker Rule has had some unintended consequences.
Kevin, what do you think? If you're going to critique the act, looking back on it, which provision do you think didn't hold up here?
I would have to clearly agree with Mike on Volcker. That was a concern that we all had, and here's how I look at it: if that's all that Dodd-Frank was a single provision, we could have a debate. But there were so many, and some of those are in conflict with each other, and why we needed to make changes. It's hard to say what has worked. I would agree with Mike as well. Title II has not, we don't know because it hasn't been used, but there have been examples of institutions that have had to go through a bankruptcy or a liquidation process. MF Global, to use as one example, through the SIPC process, that's worked and worked well. So there are tested events that we've been able to look at, and there has not been a major shock. There's not been a destabilizing event. But there are still some provisions that we continue to want to fix or had tried to fix even after, because we knew that they were problematic. They haven't been able to get across the finish line yet. I think the provisions into non-bank designations may not have been the best, because we keep having these debates about who should be in and who should be out. But so many of the provisions of the bill just haven't really, some of them haven't even really been used yet. let alone Title II. There are plenty of provisions that have not been used. So we go back and say, what was the need for them? Are they there just to be as standby provisions? If they are, maybe it's time to take a look at some of those again as well.
Sure. Jonah, let me follow up on that. It was remarked, the Fed did have to create a whole series of new emergency liquidity facilities. I think when Dodd-Frank was passed, there was a hope that financial stability would be enhanced enough that that kind of the next time there was a shock, the Fed wouldn't resort to having to use those facilities. Its 13.3 authority. Certainly it was still there in case you never know the size of the shock, and it was a important tool to still have in the toolbox. But there certainly is a hope that the regulatory system would be stronger and would hopefully not need to use it. The fact that a mere 10 years later we're back to having the Fed deploy significant liquidity facilities. What's your view of that? Is that show that the act wasn't successful in improving the financial stability of the U.S., or is that part of the normal operation of the bill?
Yeah, I mean, for starters, I think, as you said, it's I don't want to overstate the problems in terms of the Fed's facilities here. The Fed is the lender of last resort in our economy. I think it's an appropriate role for them. And, I, for one, was not super enthusiastic about restraining the Fed's 13.3 authorities. I think it's an important authority to have as a backstop. That said, I think if you look at the way that the Fed stepped in at the beginning of this crisis and the reasons that they stepped in, and Mike alluded to some of these, there are some reasons to really think hard about what was happening there. And the Fed stepped in really to support market functioning. And, I do think we should be concerned when, some of the most important markets in the US and indeed the world are ceasing to function properly. And we're talking about short-term funding markets that are critical to, in the Treasury market, they're critical to everyday funding for corporations, et cetera. So I think there are a couple things to think about there, and I'll try and just tick them off. One, I do think, when I was at Treasury, we were looking really hard at the potential impact of regulation and other factors on market liquidity. And it was hard to draw any real direct parallels between regulatory reforms such as Volcker and what we were seeing in terms of market liquidity. There was a structural transformation in many markets, and that would include the corporate bond markets here, which is relevant for a discussion around the Fed's responses last year. In terms of a transition away from dealer-oriented markets towards, sort of more transparent markets facilitated by more electronic trading. So less of a dealer-focused intermediation and more of sort of all-to-all kind of trading. And the reality of those markets, as markets transition in that way, which has happened in other markets over time, is that liquidity, looks better on a day-to-day basis, and then in a crisis can go away rapidly. And so I think there's that dynamic that regulators do need to get their arms around in some markets, including the Treasury market. And those were issues we were looking at closely when I was at Treasury. There is one, aspect of the regulatory reforms that's worth pausing on, and it's a small one. I think it gets a lot of attention, and I think the impacts are possibly larger than even the market disruptions last spring. And that's the leverage ratio, and the fact that the leverage ratio has become, I think, a more binding constraint, or more frequently binding constraint than was anticipated when it was adopted. And that's true not just for the largest banks, but for lots of banks. And the reason is, we didn't really anticipate that the Fed would be maintaining a really large balance sheet for a very long time when the leverage ratio was put in place. And when the Fed has a large balance sheet, it means banks have lots of reserves. And when those reserves are counted against your leverage ratio, the leverage ratio quickly becomes binding. And I think that's part of what was happening last spring. I'm not sure it's the full story by any stretch, but it's still with us. And, there's still a crunch in the financial system where banks are reluctant to take on deposits. So I think there's some interesting cascading effects that I would think about looking at there and recalibrating to avoid some of the unintended consequences. And my final point, just super quickly, is, Mike mentioned the micro versus macro prudential debate. And I sort of come out on the opposite side here, looking at the last crisis. I mentioned how regulators, urged banks to draw down their excess capital at the beginning of the crisis and use it to lend. I think that, combined with a lot of research that was done following the last financial crisis, which shows that financial crises are, not necessarily predicted by bank capital levels, but are predicted by lending booms and credit booms, suggests to me that some counter-cyclical policy that could push against credit booms on the one hand and ease up during a crisis on the other could be helpful. They are difficult to implement, and I think Kevin has raised some good questions about why regulators haven't always used the flexibility that they already have. But that's one area I would think about in the wake of the pandemic.
What about money market funds? You mentioned short-term funding. This is an area that Dodd-Frank partially addressed. You think it's an area they got right in light of what happened last year? What's your view?
Like, this is a good example, I think, of what Kevin was talking about. I think there's ample authority to deal with the issues that have been presented again and again at this point by money market funds. There were multiple attempts by the SEC in 2010 and then again in 2014. When I was at Treasury, we were a bit concerned about some of the elements of the 2014 reforms, in particular the potential for essentially redemption gates or fees that we thought might be causes of runs on prime money market funds. And I think the evidence from last year suggests that may have been borne out. And I think there was a good report from the president's working group under the Trump administration at the end of last year that suggests a path forward for some further reforms. I think further reforms in money funds would be advisable. I think all the authorities that they need are there, and it seems like there was certainly interest in that in the previous administration, and I hope that carries over into this administration.
Let's kind of continue on the line of things that the actually act didn't cover. Mike, are there any other areas of reform that you think should have been potentially included in Dodd-Frank that weren't?
Yeah, so I know Kevin's going to weigh in here on a couple of these too, but so I'm going to steal a little bit from him, right? So obviously one was dealing with housing finance, right? You think back to the crisis, right? One of the two biggest entities to fail that required the biggest bailouts were the GSEs, and Dodd-Frank's essentially silent on that. And we have more than 10 years later, they're still in conservatorship, and we have more government involvement in the housing finance system than we've ever had in this particular time, right? There's some credit risk provisions in Dodd-Frank that actually gives sort of an unfair advantage to the GSEs vis-a-vis the private label securities market. We haven't had sort of a growth to that. And the other thing I would mention is it didn't rationalize the regulatory system. One of the things that was apparent in the crisis is that we, as Dodd himself used to call it, the alphabet soup of regulators, all the acronyms that are out there. Not only did Dodd-Frank not take the opportunity to rationalize the regulatory system, it actually added more to the alphabet soup. And it makes it more difficult for market participants to actually, go through the maze of financial regulation. We're seeing it, before Dodd-Frank or during Dodd-Frank, no one ever heard of financial technology or fintech industry, which basically came about in the aftermath of the global financial crisis. And what we're seeing is that there's so many innovators right now that are having trouble navigating the maze of the regulations. It wasn't necessarily apparent in the crisis, and it's not going to be apparent in the crisis. But what we're seeing is that, as other jurisdictions are moving ahead of us on things like, thinking about digital assets more progressively with a small p progressively, and cryptocurrencies and central bank digital currencies, and thinking about responsible innovation that improves access to capital, financial inclusion, regulatory transparency, all the things that we like. By keeping this maze of regulators, we're actually stifling innovation and potentially future economic growth and the competitiveness of our markets.
Kevin, do you agree with that? That at one point, it looked like Dodd-Frank was actually going to consolidate the regulators, strip the Fed of its banking regulatory responsibilities, and create an entirely new standalone consolidated financial regulator. Ultimately, that's not what happened, and it moved towards adding additional regulators, more letters to the alphabet. What's your view on that? This is our fractured banking system has been around for a long time.
Yeah, it's a great question, Andrew. if I think if you had asked Mike or I, or even you, would we be a net 4 new entities?
Yeah.
That might be low coming out of Dodd-Frank. I don't think, or the crisis. I don't know if we would have agreed with or thought that was going to be the case. We still continue to have the split market regulator system. We're one of the few, if only, nations that have 2 capital markets regulators. That really could have been addressed in Dodd-Frank. So we add, obviously we add the CFPB, we add OFR, we add the Federal Insurance Office, we add the FSOC, let alone all of the new offices that were created throughout the agencies, particularly the SEC, where they added at least four, I think, new offices, and elevated them within the agency, save for one, to give the SEC chairman, something like 23 direct reports, which is interesting. So we didn't make the regulatory structure simpler, which is, of course, is one of the critiques, that agencies weren't talking to each other ahead of the crisis, and that's why we had some of the challenges. At least we had testimony on that. I agree with Mike both on the GSEs as well. And I'll throw in a third. There was, we were sitting in a recession, and yes, the goal of Dodd-Frank was to go in and be a regulatory fix to that recession, but there was nothing pro-growth in the bill to unleash capital or unleash markets that were sitting on the sideline, which is why we, in the following year, in 2011, started to work on capital formation initiatives, resulting in the Jobs Act in 2012, to try to reignite a stagnant IPO and capital markets. So there were things that Dodd-Frank could have contained. It didn't. I would agree with Mike. Probably the biggest omission was the GSEs.
Jonah, why don't we follow up on that? Which is, Kevin notes that the impact of Dodd-Frank on economic growth. We saw in the wake of Dodd-Frank really a decade of slower than average economic growth. How much do you attribute to that slower growth and job growth in particular to Dodd-Frank putting a lot of new costs and impediments on our financial system? And do you think that Dodd-Frank overdid it at all? I mean, you have a unique position because you were both not only a senior aide at the time Dodd-Frank was being drafted, but then had to go to the administration and oversee a lot of the implementation on this. So I'm curious if you think that it was too big of a load for the financial regulators and the executive branch to handle.
No, there was no question a lot in Dodd-Frank, and I think there was a lot in Dodd-Frank for a variety of reasons. And much of Dodd-Frank, wasn't specifically targeted at the crisis. I think that's the nature of the legislative process. And if you can get politics out of the legislative process, come give me a call, and we can talk about some pristine academic legislation to go construct. I think it was a lot. The evidence suggests to me that it's hard to pin a whole lot around regulation and regulatory reform in terms of the speed of the crisis, or the speed of the recovery, rather. I think there was a book published right at the beginning of the crisis called "This Time is Different," and everybody focused on the fact that the book talked about debt to GDP ratios in the neighborhood of 90% being problematic through history, but really the whole book was written about, and the title was driven by the fact that the aftermath of financial crises is just bad, and I think there are a variety of reasons for that. But if you have a financial system that is has been hit by a financial crisis and is slowly repairing itself, it's going to have a difficult time supporting the broader economy. I think the contrast between the levels of overall fiscal support that were provided after 2008 and 9, and the amount of fiscal support that was provided in the most recent pandemic, and the different recovery trajectories suggest to me that there's a much bigger elephant in the room than Dodd-Frank in terms of the appropriate policy responses here. That said, I pick up on a couple threads that Kevin and Mike mentioned. I do think, again, for better or worse, there's not a lot of evidence that regulatory structure matters all that much. The UK had a very streamlined structure and yet had a financial system that blew up. So it's not clear to me that getting down to a single regulator would make all that much difference. But of course, I did have a role at FSOC at Treasury, and I think coordinating among that many agencies is, suggests that there are real frictions there that, if you could eliminate some of those, we might have more effective responses in certain areas. And I would point in particular to some of the short-term funding market issues that have come up a couple times in this conversation. If you think about the repo market, the Fed has a hand both as a participant in those markets at some level and as a regulator. The SEC obviously has a role to play. There are related derivatives markets where the CFTC is the regulator and Treasury is the issuer of the primary asset used as collateral in repo markets. And so you have a whole lot of really interested stakeholders in that debate. And, FSOC was formed as a group that could come together and coordinate on those issues. I'd say its authorities outside of single firm designation probably leave something to be desired. And if you could beef up FSOC's authorities to conduct activities-based reviews and carry out multi-agency reforms, I think maybe we could have a more effective response in some of these areas. But ultimately, the authorities exist. It's not a matter of authorities, as Kevin keeps harping on. It's really the fact that you need a sense of urgency in addressing these issues.
So, Mike, is our PhD economist on the panel? What's your view on the impact of Dodd-Frank on U.S. economic growth over the last decade?
Yeah, so I mean, there's many ways to sort of think about the costs of Dodd-Frank, right? So obviously we've been focused on the benefits, right? So some of the costs are the direct regulatory costs on that, right? And one of the things that we know is that when you impose more fixed cost of regulation on a particular industry, right, that benefits the largest players, and it helps keep out barriers, and it creates barriers to entry for more innovation and stuff. And so what we see is, look in the banking sector, for example, right? It was, as touted as this was going to be, go after Wall Street or whatever. But, the big banks have done quite well because they can amortize those costs over large balance sheets. And I worry about how that affects competition and innovation from not only the banking sector, but some of the other ones. But one of the costs people don't talk about as much is the opportunity cost of doing a lot of these provisions, right? So the fact that, as Jonah pointed out, and you pointed out, Andrew, that, a lot of what Dodd-Frank did was told the regulators go forth and promulgate a bunch of new rules. Did Dodd-Frank, when it was passed, but that was only the beginning. It told the regulators promulgate about 400 new rules. And, then I went to the SEC and we were responsible for about 100 of them on an individual or joint basis. And so what that did was that took out basically all of the bandwidth from the SEC, and to the point where it's still some Dodd-Frank provisions still aren't done yet. Thank goodness, because some of them are particularly problematic. But what it did was it took up all the bandwidth, in the SEC and the other agencies were focused on implementing Dodd-Frank. And markets change, markets evolve, right? I mentioned the fintech industry, right? There was no such thing as Bitcoin back in the day or other cryptocurrencies or those types of things. And we've fallen behind our regulatory framework. I worry about, the competitiveness of U.S. markets and the ability to keep up and engage in discretionary rulemakings that keep up with the markets that are going on, right? I mean, we just had, I just testified a couple months ago, once in the House and once in the Senate, on sort of the aftermath of the January trading frenzy in GameStop and other so-called meme stocks, right? There's a lot of market structure issues that the SEC knows they need to fix, but they just have not had the opportunity to do it because their bandwidth was taken up by Dodd-Frank. And so those are some of the indirect costs that we need to take into account with respect to Dodd-Frank. And if I may, one other thing that Jonah brought up that I thought was particularly important was, you mentioned it was a very political process in the Dodd-Frank. One thing I would add to that too is that, each of these provisions that were in Dodd-Frank were sort of, when the way it was worked through, particularly on the Senate side, was that each one was sort of its own standalone thing to address a particular issue. Now, the issue may have been related to the financial crisis, or the issue may have been related, as Jonah points out, not everything was related, in Rahm Emanuel's words, don't let a crisis go to waste. But it was particularly problematic because each provision was sort of a standalone. And so you have provisions in Dodd-Frank that in many cases are redundant. So there's additional regulatory burdens and they're trying to accomplish the same thing. And there's even provisions in Dodd-Frank that work across purposes. So for example, in the credit rating agency provisions, right, there's the Lemieux Amendment, which is trying to decrease the regulatory reliance on credit ratings. And then there was the Franken Amendment that actually does the opposite and sort of inserts in there an SEC role for, picking who's going to rate different asset-backed security stuff. Now, luckily, that got beaten back in the conference on Dodd-Frank to just a study. And thank goodness Al Franken's, his only legislative accomplishment was only a study. So we were able to beat that back. But taken as a, if you look at Dodd-Frank as a whole, right, this is the proverbial sausage being made and stuff. It's messy. It doesn't work together as a whole complete document.
Yeah, that's been one of the big critiques, which is why, it's interesting that, over the last decade, there have been so many kind of judicial challenges to Dodd-Frank. We've seen FSOC overturn the designation of an insurance company. Most recently, we've seen the Supreme Court strike down one of the key points of dispute on the structure of the CFPB. And then we also saw Congress come in with a whole series of changes that improved the tailoring of the Dodd-Frank Act. And, Kevin, you were a key part of that process in getting S-2155 passed. Kevin, how about for you? I'm curious to know, two questions here is, one, do you think those reforms, particularly S-2155, what impact has it had on the resiliency of our banking system? And did it actually help the United States, weather our economic storm last year better? And then two is, given all the reforms that we've seen and court challenges, which I think were well known at the time, was this a case of where a bipartisan agreement could have been actually had there been a little bit more bipartisan nature to the bill? Because as you can see, some of the biggest areas of dispute have actually been overturned by the courts.
Mm-hmm. Those are two great questions. S-2155 certainly gave back flexibility that Title I took away. Mm-hmm. And said not all banks are the same, and there's very different levels of activity between a globally systemically important bank, the largest institutions in the U.S., and someone only at 100 billion in assets. Mm-hmm. And S-2155 made that clear and said, no, we have to look at a bank's individual profile and how they are operating and in which markets they are operating. And so it was very important, but I would even broaden it out, Andrew. Yeah. There were amendments made to Dodd-Frank as early as 2010, as you and I and Mike, Jonah all remember, had to have a couple of amendments immediately. We then moved, and there was never a comprehensive technical corrections bill really until you got to 2155, although not every provision was related. But immediately we had troubles with implementation of the Collins Amendment. There were troubles with the derivatives title. There were other inconsistencies throughout Dodd-Frank that we needed to fix. And if you take any of the fixes to the derivatives title, there's been no degradation in oversight. There's been no blow up in the markets. And to the earlier point that was made is, what was Dodd-Frank directed at? In a lot of cases, it might have been, the theme is we have to rein in Wall Street, but the users, the consumers, the customers, and investors were the ultimate groups that were affected by the bill. And so we were able to make some amendments, very smart amendments. They were bipartisan to some of the more problematic provisions. And none of them have brought about a crisis or a degradation in authorities or the ability for a regulator to continue to use what Congress gave them in their creating statute. As for the legal challenges, to Mike's point, Dodd-Frank was just the beginning, and then you turned over from Congress 400 plus rules to the executive branch and independent agencies, and it goes to what is your theory of the executive and their ability to act? And we saw challenges to rules on arbitrary and capricious grounds. We saw challenges to rules on cost-benefit analysis, just exceeding authorities that a regulator may not have had, and the problem was had Dodd-Frank been a little bit more bipartisan, and I can give you an example that had the Bureau title and Title II been more bipartisan, had there been a bankruptcy component, maybe we could have gotten to a better place on some of the other provisions that may not have required so many amendments, or maybe we could have gotten to a place where some of those very late night, last night of the Dodd-Frank conference provisions that came in with little to no debate may have been able to been written better, written a little more smartly, given the regulatory agencies a little more direction, rather than leaving very broad provisions open to interpretation.
Yeah. Mike, do you agree with that? You think there could have been a bipartisan deal looking back on all the reforms that have actually ultimately been made either by the courts or by the Congress or by the agencies?
Yeah, I mean, Andrew, you were there, right? We saw in the Senate, right, that we worked very closely with Chairman Dodd's team. We both worked for Senator Shelby, the ranking member on the committee, and there was a lot of agreement, I think, on a number of different issues. But then, as Jonah said, politics got involved, right? In the Senate, they had exactly 60 members for the supermajority, and so what that meant was that each particular member of the Democratic Senate had basically veto power over everything, and they also had the ability to add additional things in there. It was the proverbial sort of Christmas tree on that. And then we also saw, trying to work with the administration. There were those in the administration in the Treasury Department who were more amenable to potentially a bipartisan bill, but we also had there was some politicals in the White House that saw this as some good wedge issues on these things. And so thinking back to all the the machinations of this thing back and forth, I still think of it as a missed opportunity, right? If you look at the history of the Senate Banking Committee, the most impactful, the most robust, the most sustainable type of legislation that goes through there was done on a bipartisan basis, right? And prior to Dodd-Frank, Shelby and Dodd got together on the Credit Reform Act, right, and did some much needed things on that. So there was an opportunity that was there. It was unfortunate that it just kept getting further and further to the left.
Jonah, what do you think? Do you think it would have been, looking back now, that if you could have given up a few of the provisions that ultimately you lost anyways due to court challenges or subsequent congressional action, that it would have been better to get a bipartisan deal?
Well, if that was the bid and the ask, sure, but I'm not confident that that's where we were at, right? I mean, I think the amendments that you're talking about and the court cases have been, pretty close to the edges of Dodd-Frank in some ways. Obviously, the one involving the CFPB and the structure of the CFPB is a big deal on the one hand. On the other hand, there was a bill that Democrats fully supported coming out of the House with a very different CFPB. So that's right. We had a commission structure. So I think. And if he had told me that, Dodd-Frank was going to pass with, the provisions of the tailoring of S2155 instead of, the slightly different tailoring provisions that were in Title I of the original Dodd-Frank, I I don't think anybody would have blushed. I personally don't get all that worked up about the changes in S2155, at least as it relates to the tailoring. So I think if that was the bid and the ask, sure. I think the big question is, could we have gotten a real CFPB with a big bipartisan bill? Could we have gotten, the kinds of derivatives reforms we wanted? And, I don't know. It's an interesting hypothetical, but I think those would have been the two deal breakers for sure, at least from my perspective. But I wasn't. I was working for Schumer. He was not chair or ranking member on the committee at the time, so I wasn't quite as close as Mike and others were to those debates.
Hey, Andrew, can I just add something real quick? So Jonah brings up a good point, right? The original structure for the CFPB was a commission. In fact, that was Elizabeth Warren's first idea, for the Consumer Financial Product Commission, right? And it wasn't that Republicans were against, sort of consolidating existing authorities, because a lot of these authorities were spread across the different agencies. Again, one of the things that was nice was sort of consolidate that. But Republicans put forth a concerted effort to say, look, they would support a commission, and then two other things. One was put it subject to appropriations, so Congress could have some a check on it, so it wouldn't be just skimming off of the Fed and sort of having its own little pot of money to come from there too. And the other was to have a safety and soundness check from the prudential regulators, right, to make sure that whatever this consumer protection agency or whatever it was going to be was not operating in isolation. It had to take into account safety and soundness. Those were all reasonable sort of bipartisan things. And so, to Andrew's
the reason they didn't get done, though, Mike, just as another alternative way to view this, though, is that, in many ways, the differences were just a couple of key sections of the bill, but they represented a really big different vision and of interpretation of the Constitution, really, right? On the one hand, you have kind of the progressive view of having independent agencies handle financial regulation, kind of take Congress out of the game. As you remember, that was a big part of the Bureau, versus a more constitutional perspective where you have the executive branch more directly both accountable to the Congress through the appropriations and through accountability through the president and the unitary executive vision. And that those two visions, at the end of the day, there was just no reconciling them, and parties have different viewpoints and they vote accordingly. And, that's how our democracy works. There's no problem with the fact that there wasn't a deal there as a result, because they were both being consistent with their what they think is the best ideological approach to the issue.
Yeah, so the appropriations and congressional hook on this, right? Accountability. One of the things where there was agreement, right? If you think about, the SEC is subject to congressional appropriations, unlike some of the banking agencies, and the SEC wanted its own, to be separated from that. The appropriators didn't like that, and actually, Shelby, our office worked closely with Jonah and Senator Schumer's office on reforming what the SEC could do in terms of its budget, giving them more flexibility to have conversations with Congress in terms of, not only what the passback budget was from OMB after they submitted it to the president, but also what their original sort of bid was for that, and have more of those conversations. And it actually hardwired into the act additional appropriations going forward for, I forget, 3, 4, or 5 years, whatever it was. So, those are big issues, but in that specific case of the SEC, those were solvable. So I would put forth that maybe we could have solved them in the consumer side too.
Yeah, potentially. That'll be one of the great unknown questions. So, listen, we're almost out of time here. Maybe I'll just kind of end with one kind of last kind of question, and I'll aim it at Jonah, and you each can respond. Is just kind of quickly is, one other critique I think we can look back at the Dodd-Frank Act is we look at all the innovation which we've mentioned here. You have the rise of digital assets, fintech, artificial intelligence, a real technological change to financial regulatory structures kind of emerging. And in many ways, it looks like Dodd-Frank is kind of potentially the last of a bill that builds on kind of the old framework. And in a way did not, question for you, Jonah, is, did Dodd-Frank kind of, in a way, miss what was coming? And now we've actually got the bill really was kind of retrospective and not prospective in what were going to be the issues going forward. And now we've got a regulatory system that's going to have to catch up to all these new technological innovations.
Yeah, I mean, look, clearly Dodd-Frank, and those of us working on it at the time did not anticipate where we would be in 2021 from a fintech perspective. I mean, the iPhone was barely 3 years old when it was passed, not even 2 years old when we started debating Dodd-Frank. And much of the financial innovation that we see in our daily lives now was.
I think Mike was still using his BlackBerry at the time, if I remember, during the conference. So.
I still use a BlackBerry to this day.
Exactly. So I will say I remember that Lending Club and Prosper at the time, they were pretty nascent companies at the time, and they were lobbying for an exemption from the securities laws to be able to issue notes essentially, and call them something other than notes, and have them not be subject to the securities laws. And I think it's probably a good thing that Congress didn't go down that path. On the other hand, it was probably a good signal that, hey, something's coming here. There's a whole wave of potential innovation that may not fit neatly within our regulatory framework, and maybe we should think a little bit harder about that. So in retrospect, certainly a bit of a missed opportunity. I think we had a shot at dealing with some of that in the Jobs Act, and there were some crowdfunding provisions which my estimation didn't end up in a great place, mostly for reasons that I think Mike would agree with, based on the work we did there together. Yeah. I think there are some structural things that have only become evident over time. One is, the fintech has, mostly to date sort of structurally attacked, if you will, the financial sector by unbundling it and picking it apart, right? So we talked about Lending Club. We started with unsecured personal loans, SoFi with student loan refis, Venmo with, P2P payments, Betterment and Wealthfront with robo-advising, and everybody sort of attacked one piece of it and started to, as I said, sort of unbundle financial services. And we have a regulatory system that assumes, at least from a banking perspective, that you do a lot of things at the same time. So you take deposits and you make loans, right? We also have a regulatory system, both public and sort of quasi-private regulatory system, that assumes banks and only banks can do certain things like make payments. I think you've seen over the last few years some of the challenges and the frictions that system imposes, and people like Brian Brooks were trying to find a way forward by saying, hey, a bank doesn't have to, exercise all of its banking powers. If they want to exercise some of their banking powers, somebody wants to do that within a regulated environment, we should allow that to occur within the federal banking system and provide an option for that. And I think the big issues going forward are going to be how we deal with that unbundling and unpacking of financial services on the one hand, and then the sort of rebundling, if you will. So how do all these separate financial services work together and talk to each other? And I think there, Dodd-Frank included a provision that, perhaps somewhat accidentally anticipated that with Section 1033, which basically said the consumers have the right to allow a third party to access their bank account information. Well, that's become incredibly important in a fintech world where you can connect your different financial services applications so that they can talk to each other and share information. And that has facilitated an incredible amount of innovation over the last 10 years, sort of implicitly relying on 1033 because it's not actually been implemented by the Bureau, although under the Trump administration, there was an AMPR. And I'm hopeful that more initiatives like that will be taken. The final point I'll make, and it's just sort of a big one to drop at the end, but part of what fintech is now enabling is really the embedding of financial services into other kinds of activities. So it started with things like you take an Uber ride or a Lyft ride, and you don't make a payment as a separate transaction. It's sort of embedded within that, and I think that kind of technology is increasingly common. And that starts to bump up pretty hard against, the notions in the U.S. around separation of banking and commerce. And it'll be really interesting for me to see where that goes. And it's sort of, just an interesting structural challenge. I don't think Dodd-Frank could have anticipated all of that to the extent it could have. We certainly weren't focused on it, but these issues are real now. And I think that the big issues going forward are going to be, ones around those two structural dimensions, the sort of unbundling of financial services on the one hand and the embedding of financial services into everyday commerce on the other.
I agree. Well, listen, we could all, I think, continue this conversation all afternoon and tell a lot of old war stories, but I want to thank you for providing your insights today and participating in the panel. Thank you very much. We're going to now go to, I'm going to invite everybody to the lounge for those viewers who just joined us. If you want to join us in the lounge to network with the participants here, some of them are going to join us. So to join, the digital team will send an alert, which will appear at the right corner of your screen. Click on that alert to move to the lounge, and then click on one of the boxes that appear to quote, join a table. You'll see it as you go through. You can also join the lounge by clicking lounge on the top of your screen. You'll need to turn your camera and mic back on when you sit down at a table. We'll hope you join us. Our next panel will begin in about 10 to 15 minutes.